The history of the stock market, from its roots to today. Introduction. The stock market is one of the most influential institutions in the global economy, shaping businesses, governments, and individual fortunes. Its history spans centuries, evolving from simple trading agreements to complex electronic exchanges. Understanding this journey helps explain how modern markets function and why they remain essential for economic growth. Now, before we move on with the story, please help a small channel grow. Like and subscribe. It means a lot to me. Okay, back to the story. Early beginnings, the first stock exchanges, medieval trade, and the birth of investing. Long before formal stock markets existed, merchants and traders pooled resources to fund risky ventures. In medieval Europe, partnerships allowed investors to share profits from trade expeditions, particularly in goods like spices, silk, and precious metals. The Dutch East India Company and the first stocks, 1602. The modern stock market traces its origins to 17th century Amsterdam. The Dutch East India Company, VOC, established in 1602, was the first publicly traded company. To raise capital for expensive voyages, the VOC issued shares to investors, who could buy and sell them on the Amsterdam Stock Exchange, the world's first official stock market. This innovation allowed businesses to grow beyond individual wealth, spreading risk among many investors. Shareholders received dividends from successful trade missions, making stock ownership a lucrative opportunity. The rise of stock markets in Europe and America. London's Stock Exchange, late 17th century. Following Amsterdam's success, London became a financial hub. Traders gathered at coffeehouses, like Jonathan's Coffee House, which later became the London Stock Exchange in 1801, to buy and sell shares in ventures such as the South Sea Company. However, speculative bubbles, like the South Sea Bubble, 1720, led to crashes and early market regulations. Wall Street's beginnings, 1792. In America, stock trading began under a buttonwood tree on Wall Street in New York. In 1792, 24 brokers signed the Buttonwood Agreement, creating rules for trading securities. This informal group eventually became the New York Stock and Exchange Board, NYSE, in 1817. Early U.S. markets traded government bonds and bank stocks. The Industrial Revolution, 19th century, brought railroads, steel, and oil companies, expanding the market's scope. The 20th century, growth, crashes, and regulation. The Roaring Twenties and the crash of 1929. The 1920s saw a stock market boom as investors borrowed heavily to buy stocks. Prices soared unrealistically until Black Tuesday, October 29, 1929, when the market collapsed, leading to the Great Depression. Regulation and recovery. The crash exposed flaws in the financial system. The U.S. government responded with the Securities Act, 1933, required companies to disclose financial information. The Securities Exchange Act, 1934, created the SEC, Securities and Exchange Commission, to regulate markets. Glass-Steagall Act, 1933, separated commercial and investment banking. Post-war expansion and the rise of index funds. After World War II, markets grew steadily. The S&P 500 Index, 1957, provided a benchmark for market performance. In the 1970s, Nasdaq introduced electronic trading, making markets faster and more accessible. The 1980s and 90s saw the rise of mutual funds and 401k plans, encouraging public investing. The dot-com bubble, 1995 to 2000, where tech stocks soared before crashing. The 21st century, technology and globalization. High-frequency trading and algorithmic investing. Computers now dominate trading, executing transactions in milliseconds. While this increases liquidity, it also raises concerns about market stability. The 2008 financial crisis. Excessive risk-taking in mortgage-backed securities led to a global meltdown. Governments bailed out banks, and reforms like Dodd-Frank, 2010, aimed to prevent future crises. The rise of retail investing. 2020's platform platforms like Robinhood and social media, for example, Reddit's Wall Street Bets, democratized investing. Events like the GameStop short squeeze, 2021, showed how small investors could influence markets. Conclusion: from Amsterdam's coffee houses to Wall Street's algorithms, the stock market has evolved into a cornerstone of global finance. While crashes and scandals have tested its resilience, regulation and innovation continue to shape its future. Today, anyone with a smartphone can invest, a far cry from the days when only wealthy merchants traded shares. The stock market's history is a story of risk, reward, and relentless progress, one that will keep evolving as technology and society change. Thank you for watching my video. Please like and subscribe.